Welcome to Audio Growth Library, your destination for the most powerful insights in personal development, investing, and financial mastery. Today, we're diving into one of the most legendary compilations of investment wisdom ever written, the Essays of Warren Buffett, Lessons for Corporate America. If you're looking to understand the mindset, philosophy, and decision-making process of the world's greatest investor, then this is the audiobook summary for you. Blue Book, this isn't a typical investment book. It's a curated collection of Warren Buffett's annual letters to shareholders, expertly compiled and organized by Lawrence Cunningham. These letters span decades and contain the core principles behind the extraordinary success of Berkshire Hathaway, one of the most profitable and respected companies in the world. But more than that, these essays offer a masterclass in value investing, capital allocation, corporate governance, managerial excellence, and above all, long-term thinking. Buffett strips away the noise and hype that often clouds the investing world. His advice is rooted in timeless fundamentals, clear thinking, and a deep understanding of human behavior. And unlike most financial writing, his style is witty, humble, and crystal clear. Whether you're a beginner investor, a seasoned trader, a business owner, or just someone who wants to make smarter financial decisions, the insights in this book can change your perspective forever. Direct hit in this chapter-by-chapter audio summary, we will break down key ideas from each essay, extract Buffett's most valuable lessons, and show you how to apply them practically in your personal finance, business, and investment journey. Each chapter is designed to be concise but powerful, about 500 words, so you can absorb Buffett's timeless wisdom quickly and effectively. So stick with us till the end, because by the time you finish this series, you'll walk away with a clear understanding of how Warren Buffett thinks about money, why his investment approach has worked for over 50 years, and how you can implement those principles in your own life, starting today. Welcome to a journey through the mind of a financial genius. This is the Essays of Warren Buffett, only on Audio Growth Library. Chapter 1. Corporate Governance. We begin our journey into Warren Buffett's timeless wisdom with a fundamental topic, corporate governance. For Buffett, understanding governance isn't just about policies or formalities. It's about aligning management behavior with the best interests of shareholders. Classical building, what is corporate governance? In this chapter, Buffett explains that great corporate governance starts with recognizing that managers are stewards of shareholders' capital. When you buy stock, you're entrusting someone else, the CEO and board, to make decisions with your money. Buffett warns that too many companies treat shareholders like a necessary nuisance rather than true partners. The best businesses, he says, are ones where management acts like owner-operators, not bureaucrats or hired guns. At Berkshire, we consider shareholders as our partners, and we treat their capital as if it were our own. Bar chart Buffett's approach to governance. Warren Buffett doesn't advocate for excessive regulation or top-down controls. Instead, he believes in trusting high-quality managers, giving them freedom, and holding them accountable through performance and transparency. Key governance principles he shares. Shareholder-oriented boards. Directors should be selected based on their ability to represent owners' interests, not their social status or connections. Independent thinking. Board members must have the courage to question management, not just rubber-stamp decisions. Skin in the game. Buffett prefers directors who have significant personal investments in the company. Ownership creates alignment. At Berkshire Hathaway, directors are expected to think like owners. They are encouraged to voice honest feedback, scrutinize decisions, and even eat their own cooking, meaning they have significant stakes in the company, just like shareholders. Light bulb key lessons from Chapter 1. Think like an owner. Whether you're investing or running a business, approach every decision as if it's your money at stake, because it is. Choose leadership with integrity. A great business depends on leadership that is not just smart, but honest, transparent, and aligned with shareholder values. Governance isn't glamorous, but it's critical. The best-run companies may not make headlines for flashy governance, but behind the scenes, they create a structure that fosters long-term success. Hammer and wrench, practical applications. As an investor, Look for companies where management owns a large stake, communicates clearly with shareholders, and operates with integrity. As a business owner, build your team like Berkshire builds its board, with people who think independently and share your long-term vision. As a leader, adopt Buffett's mindset. Treat every decision as if it directly affects your personal fortune. That's how real stewardship works. Corporate governance may seem like a dry topic, but for Warren Buffett, it's the foundation of trust between shareholders and the businesses they invest in. It's not about control. It's about alignment, responsibility, and long-term thinking. Chapter 2: Finance and Investing. In an age of hype, speculation, and constant financial noise, Buffett's investment philosophy is a breath of fresh air, calm, logical, and remarkably consistent over decades. Buffett isn't interested in stock prices alone. He's interested in businesses. For him, investing is about owning great companies for the long term, not speculating on short-term market movements. A stock is not just a ticker symbol. It's a partial ownership in a business. Moneybag, what is true investing? Buffett draws a firm line between investment and speculation. Investing means analyzing the fundamentals of a business, its earnings, assets, competitive position, and deciding whether its current price offers a margin of safety. Speculation, on the other hand, is betting on future price movements with no regard for intrinsic value. He believes the best investors ignore the market most of the time and focus on what they own. The market serves you, not instructs you. Chart increasing market behavior and investor psychology. Buffett shares key principles about how to behave when others panic. When the market is fearful, that's often when the best opportunities arise. Trying to time the market or follow trends is dangerous and unproductive. Discipline, patience, and rationality outperform emotion and speculation every time. He draws heavily from Benjamin Graham's metaphor of Mr. Market, an emotional, often irrational business partner who offers to buy or sell shares every day at varying prices. The wise investor only acts when the price is favorable. Bar chart capital allocation. Another major theme in this chapter is capital allocation, the art of deciding how to reinvest earnings. Buffett believes CEOs should be just as skilled at deploying capital as they are at running operations. At Berkshire Hathaway, capital is treated with extreme care. Buffett avoids wasteful acquisitions, favors share buybacks only when stock is undervalued, and prefers reinvesting earnings in high-return opportunities. Light bulb key lessons from chapter. View stocks as businesses. Always ask, would I buy the whole company at this price? If not, don't buy a share. Stay rational in emotional markets. Fear and greed move prices. Use them to your advantage, but don't be moved by them. Be a disciplined capital allocator. Every dollar you invest should go where it earns the highest return with the least risk. Hammer and wrench, practical applications. Invest for the long term. Choose companies you'd be happy to own for 10 years, not 10 days. Build a margin of safety. Buy only when a stock is clearly undervalued based on sound fundamentals. Think like a business owner. Ignore day-to-day price swings and focus on whether the business is growing value. Buffett's investment strategy isn't flashy, but that's why it works. It's rooted in reality, driven by discipline, and powered by time. In a world of get-rich-quick schemes, Buffett's approach reminds us, wealth is built quietly, consistently, and rationally. Chapter 3: Alternative Investments. From hedge funds and derivatives to private equity and structured financial products, Buffett remains skeptical. His message is simple but powerful. If you can't understand it, don't invest in it. Beware of geeks bearing formulas. Magnifying glass tilted left Buffett's view on complexity in finance. Buffett acknowledges that Wall Street often creates investment vehicles that appear intelligent or sophisticated, but are actually driven by leverage, speculation, and opacity. These include hedge funds, derivatives, commoditized structured products, and complex private equity arrangements. He argues that these vehicles often involve high fees, low transparency, and risky leverage, which can obscure their true value and potentially blow up in periods of stress. Remember the 2008 financial crisis? Many of the culprits were alternative investment products that no one fully understood until it was too late. The derivatives dilemma. One of Buffett's most famous warnings comes in this chapter. Derivatives are financial weapons of mass destruction. While derivatives can serve legitimate hedging purposes, Buffett warns that their misuse, especially when combined with leverage, can destabilize companies and entire financial systems. He recounts real-world examples of companies that used derivatives to bet, not hedge, and suffered catastrophic losses. Warren Buffett's preferred approach. Rather than seeking complexity, Buffett champions simple, understandable, and fundamentally strong businesses that generate cash, have little or no debt, and operate in industries that are easy to comprehend. He favors businesses with predictable earnings and competitive advantages, and he avoids assets that rely on theoretical models and black box algorithms. His investment principle is timeless. Risk comes from not knowing what you're doing. Lightbulb key lessons from Chapter 3. Complexity is not equal to intelligence. Just because an investment sounds smart doesn't mean it is. Often, the more complex it is, the more risk it hides. Avoid leverage traps. Many alternative investments depend on borrowing to amplify returns and losses. Stick to what you understand. Buffett only invests in companies and instruments he fully understands. You should too. Hammer and wrench practical applications. Don't chase trendy investments. If you don't fully understand how it works, don't touch it, regardless of how popular it seems. Ask simple questions. How does this investment make money? Would it go wrong? What are the incentives of those managing it? Keep it boring. Buffett's favorite investments are often dull by Wall Street standards, but they produce real cash, real value, and real returns. In a world obsessed with financial innovation, Buffett reminds us that the fundamentals don't change. Transparency, simplicity, and sound economics always win over time. Chapter 4. Common stock investment. For Buffett, investing is not about short-term price movement. It's about buying into high-quality businesses that grow value over time. Office building stocks are businesses, not just tickers. Buffett begins by reminding investors that a stock is not a piece of paper or a blip on a screen. It's a fractional share of a real business. And your success depends on how well that business performs over time. When we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever. This long-term mindset separates Buffett from traders and speculators. He doesn't care about market noise. He cares about business fundamentals. Magnifying glass tilted right, what makes a great business? Buffett looks for companies with consistent earnings power, strong competitive advantages or economic moats, honest and able management, and sensible prices relative to their intrinsic value. He emphasizes that you don't need to diversify into dozens of mediocre businesses. Instead, focus on a few great companies and hold them as long as their fundamentals remain strong. Wide diversification is only required when investors do not understand what they are doing. Chart decreasing market volatility is your friend. In this chapter, Buffett expands on Ben Graham's metaphor of Mr. Market, the emotional partner who shows up every day offering to buy or sell your shares at random prices. Smart investors don't take Mr. Market seriously. They wait patiently and act only when the price is right. If Mr. Market gets irrational and offers you a bargain, you buy. If not, you do nothing. Chart increasing focus on intrinsic value, not market trends. Buffett urges investors to calculate a business's intrinsic value, the present value of its future cash flows, and compare it to the market price. If the price is significantly below value, you have a margin of safety and a great opportunity. He warns against following market trends, analyst forecasts, or economic predictions. These are distractions. True investing is buying value and holding it. Lightbulb key lessons from Chapter 4. Invest in businesses, not stocks. Evaluate companies like a business owner, not a stock trader. Look for durable competitive advantages. Great businesses maintain profitability over long periods. That's what builds wealth. Be patient and rational. Opportunities don't come every day. When they do, act decisively. Hammer and wrench, practical applications. Before buying a stock, ask, would I be happy owning this business if the stock market shut down for 10 years? Avoid hot stocks and trends. Buffett's success didn't come from the latest fads. It came from boring, dependable businesses. Review your portfolio with a business mindset. If the company's future cash flows still look solid, stay invested. Buffett's approach to common stocks is refreshingly simple. Buy great businesses at fair prices and hold them for a long time. It's not about timing the market. It's about time in the market. Chapter 5, Mergers and Acquisitions. In Chapter 5 of the Essays of Warren Buffett, we step into the world of mergers and acquisitions, or M&A. This is a space often driven by ego, overconfidence, and investment bankers. But Warren Buffett, he approaches it with cold, calm rationality. In his eyes, the primary goal of any acquisition should be value creation for shareholders, not empire building, chasing trends, or press coverage. Too often, the acquisition problem is the buyers, not the sellers. Many managers are better at buying than they are at running businesses. Office building, the illusion of synergy. Buffett is highly skeptical of the typical justifications for M&A deals. Strategic fit, economies of scale, or the all-too-common promise of synergies. He believes these terms often mask weak logic and overpayment. Many acquisitions, he argues, are made at inflated prices and ultimately destroy value for the acquiring company's shareholders. In corporate acquisitions, managerial intellect is often displaced by managerial ego. Brain Buffett's M&A strategy. At Berkshire Hathaway, Buffett only makes acquisitions when the company is simple and understandable. It has predictable and proven earnings. It is run by competent and trustworthy management, and the price is reasonable or cheap. He also prefers deals where existing management remains in place, especially when they're passionate about the business. In other words, Berkshire doesn't just buy businesses. It adopts them into a family of autonomous, high-performing subsidiaries. Money with wings stock versus cash deals. Buffett cautions strongly against using overvalued stock to make acquisitions. When companies issue their own shares at inflated prices to buy another business, it can dilute shareholder value. He prefers using cash or Berkshire's own shares only when they are fairly or undervalued. He also dislikes debt-heavy deals. Leverage may make a deal look financially feasible, but increases risk and reduces flexibility in the long run. Key lessons from Chapter 5. Acquisitions must create real, measurable value. If the only benefit is size or headlines, it's likely a bad deal. Price matters, always. Overpaying for even a great business is a mistake Buffett avoids at all costs. Culture is critical. Buffett looks for businesses with a strong internal culture and leadership that aligns with Berkshire's long-term values. Hammer and wrench practical applications. As an investor, be skeptical of frequent acquirers. Study if past acquisitions have added value or just added size. As a business owner, don't pursue growth for its own sake. Make acquisitions only when they align with your mission and deliver real benefits. As a thinker, don't get swept up by the excitement of big moves. Focus on fundamentals, not fanfare. Buffett reminds us that in the world of M&A, discipline beats ambition, and patience trumps growth for growth's sake. The best deals are those that are boring on the surface, but powerful in financial substance. Chapter 6, Accounting and Valuation. Welcome back to Audio Growth Library. In Chapter 6 of the Essays of Warren Buffett, we turn our attention to one of the most misunderstood and misused tools in the investing world, accounting. Now, Buffett isn't against accounting. In fact, he considers it vital. But he's very clear on one thing. Accounting numbers are only the beginning, not the end, of sound valuation. Accounting is the beginning of valuation, not the end. In this chapter, Buffett explains how reported earnings and book value often paint an incomplete or distorted picture of a company's true economic performance. Receipt the problem with GAAP. Buffett highlights the shortcomings of generally accepted accounting principles, GAAP. While GAAP is useful for standardization, it often fails to capture economic reality. For example, depreciation can misrepresent actual wear and tear or investment needs. Goodwill amortization can obscure the real value of acquisitions. Mark-to-market accounting can exaggerate volatility in long-term investments. Buffett encourages investors to look beyond the official numbers and ask, does this business truly generate sustainable cash flow? Money bag owner earnings versus net income. Buffett introduces one of his most important valuation concepts, owner earnings. While net income is a GAAP metric, owner earnings adjust for capital expenditures needed to maintain earnings, working capital requirements, and other real-world factors. Owner earnings represent the true cash available to owners after spending what's necessary to sustain operations. This is the number Buffett uses to assess a company's intrinsic value, not just its reported profits. Chart decreasing the dangers of creative accounting. Buffett also warns against managers who manipulate accounting to inflate stock prices or bonuses. He's especially critical of pro forma earnings, which exclude real costs, overly optimistic forecasts, and aggressive revenue recognition tactics. As a shareholder-focused CEO, Buffett insists that honest, conservative accounting is not just good practice, it's a moral responsibility. Lightbulb key lessons from Chapter 6. Accounting isn't reality, it's a starting point. Use financial statements to inform deeper, more economic analysis. Owner earnings matter more than net income. Always ask, how much cash is the business actually generating for its owners? Beware of manipulation. Overly complex or rosy financial statements are often red flags. Hammer and wrench practical applications. As an investor, adjust earnings to estimate owner earnings. Look at long-term cash generation, not quarterly profits. As a business owner, be honest in your reporting. Conservative accounting builds long-term trust with investors and partners. As a learner, read financial statements with a critical eye. Numbers alone don't tell the whole story. Context and common sense are key. In the world of investing, accounting is often treated like gospel, but Buffett reminds us it's just a tool. To truly understand a company, you must dig deeper, think independently, and measure value based on real economic output. Chapter 7. Taxation. Welcome back to Audio Growth Library. In Chapter 7 of the Essays of Warren Buffett discusses an area that most people dread, taxes. But instead of shortcuts and loopholes, Buffett gives us something different, a strategy of rational, legal, and long-term tax efficiency. Buffett is not a fan of paying unnecessary taxes, but he also doesn't believe in aggressive tax avoidance. His philosophy is grounded in logic, simplicity, and fairness. You should never do something solely for tax reasons, but you should never ignore taxes in making decisions. Briefcase tax-efficient investing. Buffett's favorite strategy for minimizing taxes? Not selling. By holding stocks for the long term, he avoids triggering capital gains tax. He compares this to deferred compounding. The longer you delay paying taxes, the more time your money has to grow undisturbed. This is one of the key reasons behind Buffett's forever holding period. It's not just about belief in the business. It's also financially efficient. Our favorite holding period is forever, not just for business quality, but also for maximizing after-tax results. Receipt dividends versus retained earnings. Buffett also discusses how taxation affects corporate capital allocation decisions. He prefers companies that retain earnings and reinvest them at high returns, rather than paying taxable dividends. In fact, Berkshire Hathaway famously pays no dividend. Buffett believes that if the company can reinvest profits at higher rates than shareholders could themselves after taxes, everyone wins. This philosophy has made Berkshire a compounding machine, with shareholders benefiting from deferred taxation and exponential growth. Classical building Buffett's ethical view on taxes. Interestingly, Buffett has publicly advocated for higher taxes on the wealthy, including himself. He's made headlines by stating he pays a lower tax rate than his secretary, a result of the favorable capital gains tax structure. Despite his success, Buffett believes in fiscal responsibility, fairness, and giving back. His approach to taxation is both pragmatic and principled. He follows the rules, but also pushes for reforms that promote justice. Key lessons from Chapter 7. Holding long-term minimizes taxes. Avoid unnecessary trading to defer capital gains and allow wealth to compound faster. Reinvesting beats distributing when done well. Companies that can reinvest profits efficiently often outperform dividend payers after taxes. Tax planning should support your goals, not dictate them. Make great business and investment decisions, and consider tax consequences, not tax motives. Hammer and wrench practical applications. As an investor, invest in quality businesses you can hold for decades. Minimize taxable events by avoiding frequent buying and selling. As a business owner, if your company can reinvest profits at high returns, consider retaining earnings instead of paying dividends. As a citizen, follow the law, but don't confuse tax avoidance with great financial planning. Focus on building long-term value, not just cutting costs. In a world full of tax hacks and quick wins, Warren Buffett reminds us that the best tax strategy is often the simplest. Buy great businesses, hold them long-term, reinvest intelligently, and stay patient. Tax efficiency isn't about avoiding your duty. It's about optimizing your path to lasting wealth. Chapter 8, Partnership Principles. Welcome back to Audio Growth Library. In Chapter 8 of the Essays of Warren Buffett, we explore one of the most personal and foundational aspects of Buffett's investing journey, his partnership principles. Before he ran Berkshire Hathaway, Warren Buffett managed a small investment partnership that followed a strict code of ethics, discipline, and alignment with its investors. These principles became the blueprint for how Buffett would later run Berkshire, and they're full of lessons we can apply as investors, business leaders, and partners in any venture. I will not tell you what I would not tell my family. One of Buffett's earliest promises to his partners. Transparency and trust. Buffett believed that investors deserved honest, clear, and consistent communication. In his early partnerships, he avoided hyping performance or making speculative predictions. Instead, he focused on sharing how he invested, why he made decisions, and what risks were involved. He was committed to treating his partners as true co-owners, not passive clients. He made the same investments they did and never profited unless they did. This principle still defines Berkshire Hathaway today. Buffett and Charlie Munger only win if shareholders win. Bar chart alignment of interests. Buffett's structure was simple but powerful. He didn't charge management fees, only a performance fee. He took no salary or bonus unless he beat a benchmark. He kept the majority of his own wealth in the partnership, aligning his fortunes with his investors. This incentive system ensured that Buffett's decisions were always made in the best interest of his partners. He wasn't gambling with their money. He was invested alongside them. Brain discipline over emotion. Buffett's partnership letters often emphasized rationality and patience, especially when markets were volatile or when the partnership underperformed in the short term. He asked his partners to judge him not by 1 year, but over a full market cycle. This long-term mindset built trust and allowed Buffett to focus on value, not pressure, speculation, or media hype. It's more important to be consistent than right. Lightbulb key lessons from Chapter 8. Treat your investors like partners. Whether you manage capital or a business, treat people's trust and money with the highest responsibility. Align incentives fairly. Avoid fee structures or policies that reward short-term performance at the expense of long-term results. Be transparent, especially when things go wrong. Buffett never hid from mistakes. He owned them and earned more trust because of it. Practical applications. As an investor, invest with managers who are aligned with you, not those who make money whether you win or lose. As a leader, build a culture of ownership and integrity. Your success should rise or fall with those you serve. As a communicator, be open and honest. In partnerships, trust is the currency that buys long-term success. Buffett's early partnership wasn't just a vehicle for profit. It was a model for fairness, transparency, and aligned ambition. These values became the DNA of Berkshire Hathaway, and they continue to guide Buffett to this day. Chapter 9, Corporate Culture and Compensation. Welcome back to Audio Growth Library. In Chapter 9 of the Essays of Warren Buffett explores a topic that doesn't often make headlines, but has an outsized impact on business performance: corporate culture and compensation. For Buffett, success isn't just about strategy or capital, it's about people. And more specifically, how those people are motivated, rewarded, and empowered. You can't overpay for a good manager, and you can't pay a bad one too little. DNA culture drives behavior. Buffett believes corporate culture is like the DNA of a company. It shapes decisions, ethics, and long-term direction, especially when no one is watching. At Berkshire Hathaway, the culture is built on decentralization, giving managers full autonomy; integrity, expecting honest behavior as a baseline; and ownership thinking, encouraging everyone to act like a business owner, not just an employee. Buffett chooses managers who love their business, not just the paycheck. Most of his top executives are so passionate, he says, that they tap dance to work. Designing compensation the Buffett way. Buffett is critical of generic bonus structures or pay tied to short-term stock price movements. He believes that incentives drive behavior, so they must be designed with care. Key principles of Buffett's compensation philosophy. Tie bonuses to real business performance, not manipulated metrics. Customize incentives for each business. Avoid one-size-fits-all. Ensure managers are owners, not just hired hands. Many of Buffett's managers have significant equity stakes in their operations. This results in long-term thinking, better capital allocation, and a deeper emotional investment in company success. Prohibited what Buffett avoids. Buffett strongly opposes golden parachutes that reward failure, excessive use of stock options with no downside, and short-term stock-based incentives that encourage manipulation. Instead, he focuses on creating a culture where people stay because they believe in the mission, not just the money. We want partners who think like owners, not mercenaries who chase the next bonus. Lightbulb key lessons from Chapter 9. Culture is your company's compass. It shapes every decision. Build it deliberately and protect it fiercely. Incentives matter. Structure pay in a way that rewards long-term value creation, not short-term performance. Hire for passion, not just skill. Great businesses are run by people who care deeply, often more than they're paid to. Hammer and wrench, practical applications. As a business owner, craft a compensation plan that aligns with your mission. Reward results that build lasting value. As a leader, hire people who'd still show up if they weren't being paid. Passion can't be bought, but it can be honored. As an investor, pay attention to how a company compensates its leaders. Misaligned incentives are red flags for future trouble. Warren Buffett teaches us that financial success is about more than numbers. It's about building a culture where integrity, ownership, and excellence flourish. When compensation rewards the right things and people feel true responsibility, companies thrive far beyond the balance sheet. Chapter 10. Berkshire Hathaway's Structure and Philosophy. In Chapter 10 of the Essays of Warren Buffett, we examine a business empire unlike any other, Berkshire Hathaway, and the philosophy behind its long-term dominance. In a world where big companies are often bloated and slow, Berkshire thrives with decentralization, discipline, and trust. Our formula is simple. We delegate almost to the point of abdication. Buffett's philosophy flips the traditional corporate structure on its head. Instead of centralizing control, he empowers managers. Instead of forcing synergy, he fosters autonomy. Office building the power of decentralization. Berkshire Hathaway owns over 60 operating businesses across sectors, from insurance and railroads to candy and furniture. Yet, there is no central HR department, no PR machine, and no traditional corporate bureaucracy. Why? Buffett believes that smart, ethical people do their best work when they're trusted. His CEOs run their companies independently. They make decisions on hiring, pricing, operations, all without approval from Buffett or headquarters. I'm a business picker, not a business manager. This structure only works because Buffett is selective in who he buys and who he partners with. He acquires companies with excellent leaders and then stays out of their way. Handshake, a culture of trust and accountability. The Berkshire model is built on extreme trust in competent managers, a long-term focus on value creation, and minimal interference from the top. There are no budget meetings or quarterly earnings pressures. Buffett doesn't micromanage. Instead, he sets the tone through principles, not procedures. This results in a culture where Employees are loyal. Managers act like owners, and the business operates with speed and flexibility despite its size. Warren Buffett's role at the top. Buffett sees himself as a capital allocator, not an executive. His primary duties are deploying Berkshire's massive capital into intelligent investments, finding acquisition opportunities, and selecting successors to continue the culture. He doesn't interfere in daily business operations. Instead, he steers the ship with vision, ethics, and unmatched financial discipline. Lightbulb key lessons from Chapter 10. Decentralization works with the right people. Trust-based autonomy leads to accountability and innovation. Culture scales better than control. If you build a culture of integrity and ownership, you don't need rules to keep people in line. Know your role. Buffett focuses on the high-level tasks only he can do and lets others shine in theirs. Hammer and wrench practical applications. As a leader, hire capable people, give them freedom, and hold them accountable for outcomes, not processes. As a business owner, avoid micromanaging. Build a system that runs without your constant input. As an investor, look for companies with strong cultures and decentralized leadership. These companies often grow faster and respond better to challenges. Buffett's structure at Berkshire Hathaway isn't an accident. It's a deliberate design that prioritizes people, purpose, and long-term success. In a world obsessed with control, Buffett shows that trust is the ultimate competitive advantage. Chapter 11. The Role of Shareholders. Welcome back to Audio Growth Library. In Chapter 11 of the Essays of Warren Buffett redefines what it means to be a shareholder. In today's market, too many investors treat shares like poker chips, flipping in and out for quick profits. But Buffett holds a different view. When you own a stock, you own a piece of a business. Think like an owner. In this chapter, Buffett urges shareholders to act like business partners, not short-term speculators. He also lays out his responsibilities as a CEO and the importance of treating shareholders with fairness, honesty, and respect. Adult briefcase shareholders as business owners. Buffett sees shareholders as part owners of a company, not just outside investors. This mindset changes everything. Shareholders have a right to transparency, a say in governance, and a long-term interest in how the business is run. This is why Buffett communicates in plain language. His shareholder letters aren't filled with corporate jargon. They're written with honesty, humility, and clear explanations, because that's what you'd expect from a partner. Memo: the importance of shareholder communication. Buffett believes in full, honest communication with shareholders, especially when things go wrong. He has never hesitated to admit a mistake, even if it costs Berkshire in the short term. He contrasts this with CEOs who spin bad results or shift blame. This kind of behavior, Buffett argues, erodes trust and damages long-term relationships with shareholders. The CEO who misleads others in public may eventually mislead himself in private. Handshake: equal treatment of all shareholders. At Berkshire Hathaway, every shareholder is treated equally. Buffett doesn't believe in insider advantages or special treatment for large investors. Whether you own 1 share or 1 million, you receive the same information at the same time and have access to the same opportunities. This fairness is why Berkshire never engages in stock splits or hype-driven announcements. Buffett wants long-term partners, not short-term speculators. Lightbulb key lessons from Chapter 11. Own like an owner. When you buy a stock, act like you bought the whole business. Understand its operations, risks, and future potential. Demand transparency and integrity. Great companies communicate clearly, especially when times are tough. Fairness builds trust. CEOs should treat all shareholders with respect, not favor large investors over individuals. Hammer and wrench practical applications. As an investor, focus on companies with shareholder-friendly management. Read annual letters. Study how they treat owners, especially small ones. As a CEO or founder, be honest even when it hurts. The trust you build will outlast any single quarter's results. As a long-term thinker, avoid companies with excessive spin. True leaders admit errors and fix them. They don't hide behind press releases. Warren Buffett reminds us that being a shareholder is more than a transaction. It's a relationship. When CEOs act like stewards and investors act like owners, great things happen. Chapter 12. Timeless Investment Principles. Welcome back to Audio Growth Library. In this final chapter of the Essays of Warren Buffett, we tie together all the threads woven throughout this incredible journey. Warren Buffett, with clarity and humility, lays out a set of guiding principles that have remained unchanged through decades of market cycles, crashes, and booms. The investor of today does not profit from yesterday's growth. Buffett reminds us that while markets evolve and technology changes, human nature and sound principles remain constant. His advice is not only timeless, it's refreshingly simple. Book's Principle 1. Think like an owner. Buffett's entire philosophy hinges on the idea that when you buy a stock, you're buying a piece of a real business. You're not betting on the market. You're participating in a long-term journey with that company. He encourages investors to study the business, understand its competitive position, evaluate its management, and commit long-term. This principle cuts through the noise of speculation, hype, and market timing. Principle 2. Know your circle of competence. Buffett constantly reminds investors to stay within their circle of competence, the industries and business models they genuinely understand. It's not how big the circle is, it's how well you know the boundaries. This protects investors from blindly chasing trends and helps them make rational, confident decisions based on facts, not feelings. Chart Increasing Principle 3. Margin of Safety. Taken from his mentor Benjamin Graham, the margin of safety concept means buying a business for less than its intrinsic value, creating a cushion for uncertainty, mistakes, or market downturns. Buffett applies this principle to every investment, ensuring he's protected even when things don't go perfectly. Chart Increasing Principle 4. Time is the friend of the wonderful business. Buffett's famous holding period, forever, is about letting the magic of compounding do its work. He avoids trading and timing, and instead invests in companies he's willing to hold through recessions, technological shifts, and leadership changes. Why? Because great businesses keep growing year after year. Handshake Principle 5. Integrity and trust matter most. Whether in hiring, partnerships, or acquisitions, Buffett puts integrity above all else. He believes character and values drive decision-making and ultimately determine whether a company thrives over the long haul. It takes 20 years to build a reputation and 5 minutes to ruin it. Key takeaways from Chapter 12. Simplicity beats complexity. Buffett avoids what he doesn't understand. So should you. Patience is your greatest edge. Let time and compounding do the heavy lifting. Invest in people, not just numbers. A good business with poor leadership rarely becomes a great investment. Be a student of history and human behavior. Buffett's wisdom is built on decades of observation, not predictions. Practical applications. Build a long-term portfolio of businesses you truly understand. Be conservative in your assumptions and generous in your time horizon. Avoid speculation. Embrace substance. Always consider risk before return. Studio microphone, final thoughts. As we close this audiobook summary of the Essays of Warren Buffett, one truth becomes clear. Buffett's genius isn't in complexity, it's in clarity. He's built an empire not on secrets, but on principles anyone can follow. Understand the business. Be patient. Avoid debt. Think long-term. Act with integrity. These are the timeless lessons Buffett has lived and generously shared for over half a century. Thank you for joining us here at Audio Growth Library, where we distill the wisdom of legends into knowledge you can use every day. If you found this audiobook-style summary valuable, don't forget to subscribe, like, and share this video with anyone interested in mastering wealth the Warren Buffett way.